Hi, good afternoon. You're watching Closing Trades right here on ET Now, and we're coming to you live from the SBI Live ET Now studios. And what a day it's been. I mean, so to think, we were absolutely quiet to start off trade with, and from that flat move, we finally built up a good 135 points higher for the Nifty, 0.5% up in the green, and it's almost touching 25,300 for the Nifty futures right now. For the spot Nifty, it's now decisively above that 55,100 level in trade, and you've got some of the blue chip names actually which are participating and giving that index the leg up. So look at a Kotak Bank, for instance, that's higher by over 2% right now. L&T up 2%, M&M higher by 2%, and M&M yesterday, remember, saw profit taking, so it's pretty much undone all of its yesterday's losses. iShares, Tata Steel, Bharti, Axis Bank, it's the blue chips which are really holding up in trade as we speak right now. The breadth of the market as well has opened quite nicely. You've got a GMR Airport which has perked up about almost 3.6% in trade. You've got a Chola Finance which is higher by 3%. HFCL is looking good. Cyient, NHPC, these are some of the other volume buzzers in trade. In fact, most of these names, from a Chola to an HFCL, Cyient, NHPC, they're holding on to gains over 2% to almost 3% now, touching for Chola Finance. And of course, GMR is holding up in excess of 3.5% on the futures. Handful of losers. Idea, after that tearaway 6% move that it had yesterday, that's easing down a little bit, down about 2%. BSE is down about almost 2% in trade. And then, of course, names like Varun Beverages, MCX, Syngene are also seeing some red ticks for themselves. Within the benchmarks, it's ICICI Bank, ITC, HDFC Bank. They're the underperformers. And then, of course, Trent, Asian Paints and Shriram are the ones which are also seeing some red ticks. But a decisive move today. Kunal, afternoon, what does it look like? Just a day of consolidation and we're back in the green.
Yeah, so I think it's good that the markets are not taking a big pause for a couple of days, and today's candlestick pattern is very attractive. So in technical terms, we call it as a Maru Bozu pattern. It's a very, very important candlestick pattern for the Nifty, because we managed to open at the day's low, and that from that time itself, we've managed to build up very well for the index throughout the day. The good part is that the premiums are holding up to that 99 to 100 points. My expectation was that maybe if the markets are looking to inch up higher, there may be some reduction of premium for the index futures, but that's also not to be seen. So that's another positive. And then I think the fact that we are moving up above the 25,000 mark, aided by a lot of writers on the put side. So I think that's another positive to look out for. So net, extremely positive price action for the index. My expectation is that hopefully by tomorrow or day after, we should be looking at 25,280 to 25,350 as an immediate target for the Nifty.
Kunal, is that a Japanese terminology?
Yeah.
Yeah. Explain what the chart pattern is all about.
So that's the third Japanese candlestick for you.
That's one was Marumozu, the other one was Ichi. Yeah, that's right. Which was the third one?
Third one was, I think there was one more.
Now Kunal can say any name.
Yeah. No, but coming back to the one that you talked about today, Marumozu, what is it indicating?
So it indicates strength. It indicates strength right from the start of a candlestick pattern. So I think in this case, since we are talking of the daily patterns for the Nifty, it indicates that right from the start, even though the markets opened, with a, came out with a sentiment whether SGX Nifty or the Gifty was showing a little bit of a downtick or a flattish tick, but right from the start at 25,100 thereabouts, the index has managed to gain good momentum, which means that there has been buying right from the front, and till the closing, the buying is sustaining. So which means that traders are more confident of carry forwarding long positions, assuming the index closes at the high point of the day.
All right, so that's the bullish stance coming in on the Nifty 50, and with some technical learning, of course. But with this, let me move on, and let me also welcome on board Karthik Kumar, Fund Manager at Axis Mutual Fund, joining us on the show. Hi Karthik, good afternoon and good to be speaking with you. And firstly, help us with your broad take on the markets right now, because now it seems like that the excitement is back in the markets with this GST announcement, good GDP numbers. The earnings were also not that bad. Seems like that the markets are factoring in. But the question is, where are we headed from here on?
Good afternoon. Thanks for having me. As I said, since we heard about GST restructuring, the markets has taken things quite positively. I think from here on, what will decide the course of the markets is uh, to what extent we see a pickup in consumption, and those are the data points we'll look out for increasingly in the festival season, given the cut in GST as well. So that's something the market will watch out for. And second thing is, if we do get any positive signs in terms of the tariffs and the ongoing negotiation with US, that will be another added fillip to our markets. But those are the areas that we'll be looking at in the short run. Having said that, the market is structurally positive for the long run for a couple of reasons. One is that we've underperformed emerging markets quite significantly now, as a result of which our valuations are in line with longer term averages. Valuation premiums to emerging markets are in line with longer term averages. So while our market might not be attractive in absolute terms, in relative sense, it looks reasonably placed from a valuation standpoint. Second is that while the earnings season was tepid, and we did see earnings cuts to FY26 post the earnings season, the extent of the cuts have gone down. So, for instance, in the first quarter, the earnings cuts were close to 3%. Post the results last quarter, the earnings cuts were only around 1.5%. So we are seeing a decrease in the intensity of earnings cuts as well. So I think all those things augur well from a structure standpoint for a medium to longer run.
And Karthik, hi, afternoon. This is Snehi also joining in. And you started your answer by talking about the GST rationalization. And of course, that is the big fillip that the market has been waiting for. But on the back of that, is the overall consumption pack looking more attractive to you? Or are you going to be waiting till the benefits they actually start kicking in? Or have you already, positioned your portfolio to take full advantage of that?
I think it comes down to sectors and subsectors. So, for instance, in some cases, a cut in GST could actually help aid volume growth. In some cases, in some industries, it may not be as elastic as one would think. So, in those areas or in those subsectors, the GST cut might not necessarily incentivize volumes. But in our case, we even prior to GST, we were bullish on, let's say, value retailers. We were bullish hotels, tourism. Those are areas that have a structural tailwind. And given what has happened with GST restructuring, I think that just adds to the thesis. So those are areas that we are already bullish on.
Right. So, Karthik, what is it that you're doing in your funds right now? What are the biggest overweights and underweights?
So from an overweight perspective, as I said, we are bullish some of the consumption, more discretionary oriented themes that I mentioned before. Aside from that, we are overweight power, T&D, telecom, and financials, largely across the board. Slightly selective within capital market themes, but otherwise we are bullish financials. Those are the sectors that we are bullish on. And from a style perspective, if we look at it, I think given when the markets start seeing when we start seeing an uptick in earnings, wherein the next 12-month earnings or so starts trending positively rather than the slight negative revisions that we are seeing right now, I think the focus will be back to growth, and growth style in conjunction with quality kind of looks good over the medium to longer run.
All right, so those are some overweights in the portfolio that Karthik just talked about. But other than that, Kunal, one of the newsmakers today is actually L&T, and wanted to have a chart check by you because just today the company announced a new order win, which was decent enough. I think it's over 1,000 crores, but just yesterday they announced an order win of more than 2,500 crores in the range of 2,500 to 5,000. But technically, a 2% move for a slow mover for L&T, what does it mean?
So I think this was due. This was like, as if a point where the index has moved up almost 700 points and L&T had not participated. In fact, L&T over the last, I think, 3 or 4 weeks prior combined to the previous week's price action, was actually showing signs of negative price correction. The stock had corrected from 3,700 to I think 3,500, 3,550 thereabouts. So statistically, we've seen L&T is one of those stocks on the large cap Nifty 50 basket, which has a much higher correlation with respect to its I'm not saying immediate sector peers, but the overall index peers. So I think with a correlation of more than 75 to 80% in many instances. So I think in that context, L&T is trying to play a good catch up, something which I think other large cap stocks like HDFC Bank and Reliance have still yet to do in that same price intensity. What this also brings in for L&T at this 36, 60, 70 levels for the stock is now we are spotting an inverted head and shoulder pattern for the stock on the line chart, and I think if the stock manages to break past about this 3,700 barrier, we could be looking at a further up move of at least another 100 points on the upside. So an initial start to a short-term breakout has happened, but the second breakout could happen once the stock breaks about 3,700 mark.
Okay, so that's a chart check on L&T. Time now to slip into a very short break. We'll keep the conversation going with Karthik and Kunal on the other side. Back with closing trades, and you're joining us live here in the Mumbai studio of ET Now. That's the SBI Live studio. And let's get stock specific talk about Maruti Suzuki that has finally announced prices for its new mid-size SUV, the Victoris. The Maruti Victoris is priced from 10.5 lakh rupees to almost 20 lakh, 19.9 to be precise. Bookings for the Victoris have been underway and is exclusively sold through the Maruti Arena showrooms. Shrishti is joining us with more details about this new launch. Shrishti.
Well, yes, Maruti Suzuki has come out with the prices of the latest offering, that is Victoris, mid-size SUV with a lot of first-hand features coming in on this particular vehicle. The excitement is all about the new features that Maruti Suzuki has come out with in this particular vehicle. But the other exciting fact is the pricing, because the company has come out with quite an aggressive pricing, because the introductory prices is starting from just 10.5 lakhs, but goes up to 20 lakhs, because in this wide range, the company is offering multiple fuel types. It's not just the petrol, you will also get a smart hybrid, a strong hybrid, as well as the CNG offering. And it's also interesting to note that this is quite aggressively priced versus some of its competitors in the same range, from the likes of Creta, Kia Seltos, as well as Honda Elevate. But in terms of the cannibalization effect for Maruti Suzuki, we have been telling you on ET Now that the whole product revamp is underway, and Maruti Suzuki is planning to come out with very interesting offerings. Victoris is one, but in that as well, if you see the placing of this particular model, at least in terms of the pricing, it's actually in between Brezza as well as Grand Vitara for now, because you can see right there on your screen that for now it is actually almost a 5% cheaper versus Grand Vitara. Do remember that the new pricing for Maruti Suzuki launches will be announced soon, because from 22nd of September the company also has to adjust the prices of their variants across the models. But keeping in that view, the analysts are very much bullish that given the features, given the pricing, the company is expected to garner sales close to 4,000 to 6,000 units per month. And that is exactly what even Nomura is highlighting, because the combined sales from Grand Vitara as well as Victoris, they are penciling in a 15,000 sales per unit. They are bullish that the company is expected to do better, and even the company itself is confident that some of their competitors which have offering with diesel heavy portfolio, they can benefit out of that. For Nomura, they are currently targeting in a 9 to 6% YOY volume growth, maintaining their neutral rating with a target price of 15,031 rupees. But all in all, it's indeed a very aggressive pricing coming in for Maruti Suzuki Victoris. Back to you.
Right, okay, that's the new launch from the Maruti stable. But Srishti, thanks for highlighting all those details. Let's also take a look at what else has been holding up in the market. Of course, autos have been the strongest ship, and you have seen quite a bit of rebound play out ever since the GST rationalization announcement. But Kunal, we always go back and forth on autos, but it continues to be M&M, which I guess is the leader within autos, right?
Yeah, so I think M&M has been a leader, in terms of price performance. But I think I also sense that Maruti is making a very strong comeback, and the stock I think up some 30-35% so far on a YTD basis. This has been a brilliant year so far for the stock price. The comeback, from that 11,500, 12,000 mark as a breakout point for Maruti, I think that has been a huge change of price trend for the stock price. And so largely, I think over the last 2 or 3 years, M&M was one of the strongest performer. Maruti was a huge underperformer. So I believe that now it's a wave where the underperforming stock is trying to make a comeback. Maybe not a a like-to-like catch-up in terms of the strong performer with respect to M&M, but I believe Maruti over here could also stand chance to gain significantly higher from current levels also. So I think both these stocks should do reasonably well, and that overall should aid the movement for the entire auto sector. So dips like what we've seen in the last 3-4 days, 3-5%, I think should be taken as a good averaging or a buying opportunity.
Okay, so Kunal, that's your take on Maruti Suzuki and overall the entire auto pack. But what about some stock-specific recommendations that you might have for our viewers today? Any stock that has made it to your BTST radar today?
So two buy calls. In fact, M&M is something which I picked because of the fact that the stock in the last 2-3 days had corrected and now it's bouncing off from its 20-day moving average. So keeping that as a stop loss, 35.50, would recommend a buy with 3700 as a target for M&M. And the second is a buy on Bharat Forge. Now this could be a very interesting chart. The stock after quite some time has managed to come back above its 200-day moving average. There is also a signal of a bullish crossover on the moving averages on the daily chart. So if the stock manages to cross about 1275 mark, Bharat Forge could be an interesting name, 1300 as a target, stop us at 1235.
Okay, that's a buy on M&M as well as Bharat Forge from Kunal. We'll take a very quick break. The gains on the markets are holding through. Let's see how the last half an hour pans out for us.
Hi there, welcome back to Closing Trades. Last half an hour of the market, and market is holding up pretty well right now. But let's get stock specific once again and understand the math of taxing buybacks, because remember last week we've had the big announcement coming in on the Infosys buyback, and we have Ashesha with us to explain how the tax math will impact the shareholders.
All eyes are on Infosys 18,000 crore buyback, which has been priced at 1,800 rupees per share. But the buyback taxation is a little complex, especially because the rules have been amended in the last 1 year or so. Now, remember the total amount of consideration that you will receive from the company, which is 1,800 rupees per share, is taxable as dividend income in the hands of shareholders. Dividend income means that this will be a part of the income from other sources section of the total income. And remember, the cost of acquisition, which is the price at which you have purchased the share, will be allowed to be set off against any capital gain that you have, which means this will be considered as a capital loss, that is the cost of acquisition, which can be set off against capital gain either in the year of transaction, which is this year, or it can be carried forward over a period of next 8 years. This is definitely detrimental for non-active shareholders, which means that if I don't have a corresponding capital gain to set it off against, then I will have to carry forward this, but I will have to pay full tax on the total amount of consideration that I am receiving from the company at the moment. Now, apart from this, the company which is doing the buyback, which is Infosys in this case, will also be deducting TDS. The rate of TDS is 10% for resident shareholders and 20% for non-resident shareholders. This translates to 180 rupees per share for 1800 rupees buyback and 360 for non-resident shareholders. This TDS amount, of course, will be set off against the total taxable amount. The dividend income, which is considered in the total computation of income, will be then taxed at the slab rates according to your total income. So yes, the issue is a little complex, especially because the full amount is taxed now and the total cost of acquisition can only be set off over a period of time as and when you have capital gains. So yes, it's a little complex, but the buzz in the market is that it is detrimental for small shareholders and perhaps slightly more beneficial for FPI shareholders, because taxation for buyback is slightly more favorable for foreign portfolio investors.
All right, thank you so much, Ashesha, for helping us understand the math behind taxation, especially when it comes to the buyback announcements. But with this, let me move on and let me welcome Nandisha, who is joining us on the show right now from Motilal Oswal Financial Services. A very good afternoon, and thank you so much for your time. And a lot of sector churning is underway, but one such sector that is buzzing away is actually the metal pack. If you can help us understand what's your current outlook on the metal, and is it really looking interesting to you at this point in time?
Thanks for having me. Currently, we are positive on the metal space, especially on the ferrous and the non-ferrous part both. On the steel part, we like NMDC, JSW Steel and Tata Steel. And on the non-ferrous part, we like Vedanta and Hindalco.
That's the take coming in on metal, and those are some of the stocks you're liking. Let's just take a look at the flash on the bottom of the screen, and after you've got some FMCG staples names like HUL and Dabur that have come out and reduced their prices. You also have Mother Dairy that's been cutting their price of milk and other dairy products as well. Nandish, your take on how much the GST rationalization could boost consumption overall in FMCG, because staples maybe not that much, but what about discretionary?
So we expect that the discretionary consumption is likely to pick up post this cut in GST rates. We also feel that consumer discretionary is also likely to see some pickup because since last about 9 to 12 months, there has been hardly any pickup in the consumer staple side. Now with inflation coming down and with GST rate also been cut, we expect some consumption boost happening across the board.
Right. Okay. Kunal, staples, that's not a pocket that you would want to trade, right? FMCG?
Not really as of now, Aisha, because it lacks momentum, and I think we've seen FMCG performing very well in that phase when the markets were into a lot of volatility, choppiness, uncertainty, correction, etc. So I think in that phase, FMCG did well. And the moment the markets got a whiff, that this could be a stable recovery, and you might see the maybe the global issues, etc., ironing out. I think that's where you've seen FMCG stocks take a pause, and the money's moved back into the traditional high beta or the rate sensitives, etc. So I think in that sense, it's better to just about wait out for a point where these stocks may start to look attractive. Maybe a retracement towards their individual 20-day moving averages or 50-day moving averages, depends on how far these stocks are placed above those levels. I think would be a good retracement point to add these names.
Okay, the one other stock which has been in focus today is Swiggy, and they have launched a new app called Toins for affordable food delivery options, and the prices on the app range from as low as 49 rupees to a maximum of 250 per order. In fact, we've compared Swiggy's offering with the other existing platforms as well and try and understand the difference over here. Anjali, in fact, my colleague, is here with more insight.
Right. So Swiggy has launched a brand new app called Toins, which is going to focus specifically on affordable food delivery options. Now this has been launched as a pilot currently only in few select key areas in Pune, and it will have offerings mostly in the range of 49 rupees till 250 rupees, which is largely the affordable segment. But what is it that is different between this new app versus the main delivery app that Swiggy has? Well, one is that there will be no surge fee on this one even during peak hours, and it will also attract a lower platform fee of rupees 12 versus rupees 15 that we see on the main app, and it will also have parity with offline prices, which means the prices that you will see on menu cards in restaurants is what you will see on this app as well. So those are the major key differences between the existing Swiggy app and this new app. We also compared the prices or the total final price that you pay for a particular item, and what we found here was that the same item was listed at 225 on Swiggy, whereas it was listed for 200 and then discounted to 149 on Toins. There was also a delivery fee of 41 rupees without a Swiggy One membership that was on the main app versus 0 on Toins, which has free delivery on orders above 99 rupees. Additionally, no packaging charges were levied, and the restaurant GST was also lower given that the cost of the item was lower. And platform fee, again we can see a 3 rupee difference, which comes out to a difference of almost 80% of a price differential was seen between Toins and the existing Swiggy app, which means that Swiggy is really going all guns blazing into the affordable segment. Now there are a few things to set context on why this app has been launched. Sources told us that this is to largely cater to the affordable category, and in a shareholders letter Swiggy had earlier said that they will ensure that peers don't get a clear opening, and they had also launched other offerings like the 99 store within the Swiggy app as well as snack, both of which focused on the affordable segment. At the same time, we have rivals like Rapido that are entering into the food delivery space again with affordable options, with them asking restaurants to put at least 2 items under 150 and therefore lower prices on such platforms. Swiggy also has ownership in Rapido, about 12% that they are also looking to sell, which means overall Swiggy wants to make sure that they capture the affordable segment as well, and this new offering, this new app is a step in that direction.
Okay, Anjali, thanks so much for taking us through that. So that's on Swiggy's new launch, Toing. And Nandish, your view on this entire competition that we're seeing evolving in the quick commerce, quick food delivery. And now if I could, introduce a new category, it's affordable food delivery, because you have a lot of competition that's going to be brewing up here pretty soon now that Swiggy has forayed into this. Your take on what the competition looks like and your preferred bet between Swiggy and Zomato?
So we have been positive on both Zomato as well as Swiggy, and currently our preferred bet is Swiggy, with almost about 15 to 20% of the growth coming from the food delivery business, and with Instamart also being a market leader in some of the spaces where they are connected. Currently we like Swiggy in terms of valuation also.
Yeah, definitely valuation comfort does favor Swiggy as of now. But Kunal, now that you have enough chart data on Swiggy, I mean, not as much as Zomato for sure, tell me what's looking like a stronger one.
Yeah, of course, Eternal or Zomato is the strongest one. But, even Swiggy on its own space is trying to get back into a phase of recovery. So, when you do a like-to-like comparison, there was a point where Zomato Eternal was at 40 rupees or 45 rupees. The stock formed a base and then start to move up higher. There was a point where I think, if I'm not wrong, for 10 or 11 consecutive quarters, the stock gave positive returns. Now, you try and so that tells you the speed and the steep prices the stock had seen in the recovery post that. That's not something which we're seeing for Swiggy. And for Swiggy, I think it's been just about a very steady recovery so far. I think in the last 3 odd months from March, April somewhere, when the stock bottomed out at 300 mark, we've seen the stock gradually moving up to that 400, 430 mark. So it's a different chart altogether. Of course, maybe not as strong in terms of momentum, but then, there are times when stocks just about try to, take a lot of time to try and recover and get back into a breakout mode. The lifetime high for Swiggy has been around 600, 620 plus mark. So I think in that zone, there is a lot of catch up and covering up the stock has to do when it has to, break past about those life high levels. But I believe that the initial work in the prices, I think, has been done. The base has been formed at the 300 levels, and gradually I believe that the stock should look attractive. So traders who are looking to buy over here, I would suggest that you should have a medium to longest term time frame if you're looking to chip into these names.
Okay, so that's the take on Swiggy and Zomato on the charts. Kunal, I remember that you were also positive on Nykaa a while ago. And why I'm talking about Nykaa while we're talking about Swiggy and Zomato is that today when the government has come out with their list of FAQs on GST, they've come out with an FAQ on who is actually going to bear the brunt of that 18% delivery on local services. And that is now the problem of the e-commerce operators and not the people who are responsible for delivery. So that FAQ has come out today. So this could also impact Nykaa to some extent and their delivery fleet. So that is how I'm trying to connect Swiggy, Zomato with a Nykaa, because I also remember you were quite positive on Nykaa. Is that view still there?
Yeah, it's still there. In fact, this is the 7th consecutive month of price action positive for Nykaa. So I'm sure, that, on the basis of price recovery, maybe the stock could just stall over here for a couple of months because of that steep price rally in the last 7 months. But then this tells you that this has been a one-off major trend breakout for the stock price. And remember, I think 2021-22, when the stock listed post the listing, the high was around 420 or 440 about for Nykaa. And from there, the stock had fallen down to, I think, 120 or 130 levels. So after falling almost till 1/3, the stock is trying to get back into a repair process. 7 consecutive months of price rally for the stock. And it indicates that we are looking at a major turnaround for the stock.
Right, so that's about some of these new-age tech companies. But moving on, and all eyes will be on the much-awaited FOMC meeting, where the street is anticipating the first rate cut of 25 basis points this year. Let me take it across to Varun Dubey, who is standing by to tell us what more to expect. Varun.
Well, so the street is estimating a 25 basis point rate cut in the September meeting of FOMC, and after 2.5 years, that is after June 2023, this would be the first rate cut in the US markets. and the Fed range, which is around 4.25 to 4.5, will actually start moving down. And it is not only this time, Street is also expecting a rate cut going forward. If you look at the Reuters poll of 107 economists, around 105 are expecting a rate cut in the September policy, and around 60% of the economists are also expecting a rate cut in the coming policies as well. So a total of around 50 basis point of rate cut is expected in the calendar year 2025, and that is 60% of the economists are expecting a 50 basis point rate cut in calendar year 2025. And also some are expecting further rate cuts in calendar year 2026. So they are expecting a total of 75 basis point rate cut from here on till the next year. So the rate cut cycle is again to start after 2.5 years. Now there are several factors which are actually leading to the rate cuts. No doubt, if you look at the inflation numbers, they are actually expected to inch up because of the tariff war that is going on. But yes, if you look at the other economic data points of the US market, especially the unemployment data, that is something which is actually worrisome. And if you also remember, during the Jackson Hole Symposium, the Fed chairman was actually sounding unemployment data to inch up going forward in the US markets, and this is one of the important data points because of which Street is expecting a 25 basis rate cut in the September policy. And also going ahead, you might see a series of rate cut in the US markets. So after finally 2.5 years, that is Jan 2023, the rate cut cycle in the US market is about to start with a 25 basis rate cut in the September policy.
Absolutely. That's what one is anticipating from the Fed and what the trend has been. But yes, all eyes on the Fed this time around. Perhaps finally, after a very, very long time, they're going to finally move on the curve and begin easing rates. But that said, just looking at the index right now, by the way, we're at the day's highs. Let's just bring up the Nifty intraday graph. We're currently at 25,235. So we've suddenly shot up in the last few odd minutes or so. What looked like we're just going to about make it to the 25,100 mark. We've eked out a good 164 points up in the green right now. And I just want to bring up the list of the contributors as to what is it that it's actually leading and, moving up the Nifty. It was banks. I mean, that's where the first signs of a pickup actually came in. You had the likes of a Kotak, as well as Axis, which are actually leading within the private banking space. But I think now even HDFC Bank and ICICI Bank have somewhat picked up, or at least beginning to inch up a little bit. Still not participating in today's move, but at least those stocks have kind of turned tide, or at least are attempting to do so. Kunal, within banks, where do you see leadership next? Because today it's really about Kotak and Axis all the way.
Yeah, so I think ICICI Bank is something to watch out for. I believe, when I look at the sensitivity of prices across the private sector banking names, it started off with ICICI Bank showing that some promise and confidence, when it managed to make a comeback. I think yesterday, if I'm not wrong, where the stock managed to come back to that 14, 20, 30 mark. There was a point where, there was some sort of a confidence which is brewing back again, that maybe the private sector banking stocks could also try and come back again. Then we look at this as a relative positioning. ICICI Bank and HDFC Bank are the two names which are still trading, above the longer term averages. Compare this with the likes of Kotak, Axis Bank, etc. I think except for the last couple of days of price action, these stocks were holding, far below their longer term averages. So which means that there's a lot of catch up which these stocks have to do. But I believe in that sense, once the confidence comes back into a particular index, then the larger cap names are the ones which, charge premium. And I think in that sense, I would believe ICICI Bank could be one of the stronger candidates over here. If the stock manages to break past about this 1430, 1435 level on the short-term charts, I would probably expect that this could aid, a further up move of at least another couple of percentage points on the Bank Nifty.
All right, so that's about the banking majors. Yes, of course, very good moves coming in on Kotak Mahindra Bank, which is the top gainer since the start of the day. What's not doing well within the paint basket is actually Asian Paints, because towards the second half for the past two to three consecutive trading sessions, we are seeing that the selling pressure is intensifying on Asian Paints, and even today as well, you will see that the stock is down almost 1%, and even in the past 7 days, it's almost a 4% correction that we are getting to see. Kunal, a quick chart check by you on Asian Paints. How do you see this counter on the charts? Because given the fact that we will be entering the festive season in a big way, no such excitement on the paint major.
Yeah, no excitement on the stock, and in fact, every rally is being sold into for Asian Paints. I remember, I think just about last week or so, the stock was at 2570, 2580 levels, and from there, you've seen the stock correcting 100 odd points. So it's not the intensity of price correction, but it's just that closer to a breakout point when you see suddenly the stock reversing and then losing out the advantage which the stock would probably have garnered after this major price recovery from a huge underperforming zone. That puts off short-term traders. So I believe in that context, maybe the stock would just about remain at these current price ranges. 24, 25, 100 could be a pivot support for the stock price, and on the upside you might look at 2600 as a resistance. So no major call of a trend for Asian Paints as of now on the short-term charts.
Now I want to ask you about a stock that is suddenly, it's really high and rated. We've not seen this move coming on Reddington. I don't know if you track Reddington. It's a stock we haven't spoken about in a very long time. A 20% spike up coming in. During the mid-market day, we did see some block deal action happening on this stock, but nothing significant in terms of news flow for such a big move. What is your reading on the charts for Reddington?
Yeah, I tracked the stock in between when it was up 12-13%, but it was difficult to fathom the view because the setup as such, because for the last 1 month, the entire month of August, and I think prior to that the end of July, the stock was actually going through a major corrective phase. So from 330 levels, the stock had fallen down to almost 30%, 240, 230 thereabouts. And after that kind of a price correction, there was no major setup on volumes, etc. So I'm sure traders who are looking at a contraband Reddington, they would be caught in for a surprise on the upside. I'm not sure whether the stock will see a very similar kind of a follow-through up move, because when you don't see generally a major volume pattern before a strong move, that move generally fizzles out, or it requires a lot of confidence from traders to try and buy the stock whenever the stock dips post that. So I actually believe that maybe over the next couple of days, once this move settles down, the stock may actually come back into a corrective phase and come back to say 260, 270 mark.
Okay, that's that on Reddington, and Nandish is also back with us. Nandish, within the entire EMS space, what is it that's looking interesting to you, and the whole debate about, how much of the run-up has already happened, whether valuations are comfortable or not? What is your preferred list?
So in EMS the segment, we like Keynes Technologies, Dixon and Amber Enterprises are our top picks.
Okay, so that's the take coming in on the EMS space. Nandish, anything else looking good to you? We've not spoken about pharma, but recently we've seen lots of US FDA action coming in, lots of new launches, the likes of Zydus launching a lot of pet care drugs today. Your take on the pharma space, Nandish?
So in the pharma space, we like companies basically for focusing on the CDMO part. We also like the hospital space. So we are not that positive on the generic space as such, but we are positive on CDMO players like Laurus, Blue Jet Health.
In healthcare and hospitals, like you were saying, what's the preferred lot? Not like there are many listed options in any case.
So yes, so in the hospital space, we like Apollo Hospitals and Max Healthcare.
Hospitals is the preferred counter within the healthcare space, so let's watch out for that as well. But other than that, we are seeing very decent moves, or rather good moves coming in on select real estate counters. See the likes of DLF, that has shot up, even Lodha is holding up, and even stocks like Prestige Estates, they are also doing very well. But Nandish, can you help us understand why is there a renewed excitement with respect to the real estate counters, especially some of these large caps? A renewed interest is seen, at least on the stock price. But anything incremental that you are picking up and you wish to highlight what's happening in the real estate basket?
So with GST rates coming down, especially on the cement side, we feel that over a period of time, the biggest beneficiary will be the real estate companies like DLF and Lodha, and and in the southern-based real estate companies, we like Prestige. So these are, I guess, with interest rate coming down and affordable housing segment even becoming much more attractive, real estate space can see a good action in the near term, in the short to medium term.
All right, so those are some of the factors that is definitely is looking exciting to the investors, and Nandish also shared some of the topics that he's liking at this point in time. But Kunal, a quick chart check by you as well. How do you see the whole real estate pack, and anything in particular that is looking good to you? Because today morning there was a report coming in from Antique on overall realty. I see at least that stock hasn't participated much, but any other stock that is looking good to you?
So I think DLF, Godrej Properties and Oberoi Realty are the top three names over here. Prestige also could be a good buy at current levels, because of the way the stocks have underperformed. Look at it this way, that, the real estate basket, I think just 2 months back, end of May or start of June, was almost at 1,050, 1,060. And from there, we saw the index falling 200 points. That's almost 20%. So I think in that context, you are looking at potentially that if the markets recover, the sectors start to show signs of recovery, we may look at the realty pack at least trying to claw back from that 200-point correction and come closer to at least the midpoint of this 200-point drop. So maybe closer to 950, 975 is where you can expect the real estate index to head towards. That's at least another 7% from current price juncture. And that could probably mean that maybe the individual stocks or few of the performing names could rally up at least 7 to 10%. So there seems to be a good room for a swing trade over here for many of the real estate stocks.
Today is turning out to be one of those days when you actually wish the trading day was a little longer, because 20 more points and we should actually make it to 25,300 on the Nifty spot. We're just 50 points shy actually of that mark right now. 24,250 is where we're at, and to think of it, we had one of the flattest days yesterday, an extremely quiet start today as well, and then in the second half that pickup has actually happened, pretty much drawn up by blue chip names like Kotak, L&T, M&M, Eicher, Bharti. They've all contributed to today's move. A couple of these technology plays as well have participated in the Nifty move today, and everything from an Infi to a Wipro, 8cell Technologies, TCS, TechM, they've all held up quite smartly. And then, of course, what turned tide was also ICICI Bank, HDFC Bank, although these stocks have closed and flat, but Reliance has actually picked up. And if we can just bring up the intraday graph, because up until mid-session, Reliance was lying quiet, and then you saw a pickup in Reliance, and perhaps that's what's rubbed off on the Nifty as well. Closing in with a 0.5% gain, it's made it to 1,400, and that's also reflective or has its bearing on the index too. But Nandish, Kunal, both of you, thanks as always for your time, and I'm going to hand it over to Snehi for closing trades.
Absolutely. Let's take a look at how the market session has panned out today, and what a day of trade coming in, because the pickup that we've seen, especially in the second half of the trading session, has been phenomenal. A very good Nifty expiry shaping for us today. So Nifty 25,256 at the highest point of the day is where we're closing 0.7% higher. Sensex too, similar moves coming in, 0.8% higher for the Sensex. Good moves coming in for the Sensex in today's trade as well, about 650 points higher on the spot. Nifty Bank has also done decently well for itself, for 0.5% uptick coming in, and you actually had names like Kotak Bank that was the top Nifty gainer today, more than a 2.5% uptick coming in on that stock. That has led the banking index to do very well for itself today. The broader end of the market was also quiet. Okay, mid cap was up 0.5%, but the small cap index continues its outperformance, once again exceeding the entire market breadth of the market and the benchmarks. A 1% move coming in on the Nifty small cap index as well. Advanced decline ratio looked very healthy. India VIX was lower by about 1.5%, so looking healthy on that front as well. Like we mentioned, Kotak Mahindra Bank, your top Nifty 50 gainer. Following that, you had L&T, M&M, Maruti Suzuki, Eicher, Bharti, Airtel, Tata Steel, all of them trading above 2 or above 2% each. On the flip side, some pressure from Shriram Finance, Asian Paints, Tata Consumer, Nestle, Bajaj Finance. Nominal cuts coming in across all of these stocks. Sectorally, the day belonged to the auto indices. They were in the fast lane today. Good moves coming in across names like MRF, M&M, Bharat Forge, Eicher, Maruti. All of them have done well, followed by Nifty Realty. Good moves coming over here as well. Prestige, Phoenix, DLF, Anantraj. All of them continue to do very well. So along with that, you had IT, Energy, Metal, PSU banks and Pharma that have done very well for themselves. On the flip side, you only had one index that was slightly under pressure, and that's the entire Nifty FMCG space. space. So if you take a look at some names like Varun Beverages, Tata Consumer, Dabur, Marico, Nestle, Colgate, so some of these staples, they were under pressure today from the Nifty pack. Other than that, overall, very good move coming in on Reddington on the back of some block deals, a 20% uptick coming in on that stock. Godfrey Phillips up 7%. Aegis Logistics has done well today along with GE Shipping, Mahanagar Gas, Chola Financial and GMR Airports along with Aadhar Housing Finance. On the flip side, some pressure on JBM Auto, Garden Reach, Ola Electric, Brigade, Godrej Industries, Varun Beverages. So it's a mixed bag of Nifty 500 losers coming in. All in all, it's been a very good day of trade coming in for us. Some exuberance is something that we've finally seen in the market, and Nifty closing around that 25,250 mark. We'll give the rate some time to settle. But that's what it looks like at market close today. That's a wrap on closing trades. Thanks so much for tuning in.